December, late 2025. Silver is trading above $79 an ounce, not on hype, not on speculation, but on panic. And not retail panic, industrial panic. Because something has changed, not gradually, not quietly, but decisively. The financial system is losing control of silver pricing. And the buyers, now setting the price, are not traders. They are builders. Let's start with the signal the market cannot ignore. Nvidia, the most important AI hardware company on the planet. A company that does not speculate. A company that does not chase trends. A company that only moves when supply chains are at risk. Nvidia just announced a $20 billion acquisition tied to AI inference hardware. Mainstream headlines framed it as software, but that's not what this is. This is about metal. AI inference hardware is silver intensive. Exceptionally silver intensive, every high performance chip, every advanced interconnect, every thermal interface, every power delivery layer. Silver is not optional. It is not one of many inputs. It is the input. And Nvidia knows something the market is only beginning to understand. There's not enough silver, not at scale, not at speed, not at the quality required. This is why the price is behaving the way it is. This is not a rally. This is not a squeeze. This is a structural break. The era of paper control is ending, and the era of physical dominance has begun. For decades, silver pricing was managed through derivatives, futures, swaps, leverage, a system where hundreds of ounces could be sold on paper for every ounce that actually existed. That system only works when physical demand is flexible, when buyers can wait, when substitution is possible. That world is gone. Today's buyers are not price sensitive. They are production sensitive. If Nvidia can't get silver, data centers don't get built. If Tesla can't get silver, EV lines stop. If solar manufacturers can't get silver, panels don't ship. And factories don't negotiate with price charts. They bid. This is why $79 is not resistance. It's a warning. Now look at China, because this is where the situation turns from tight to explosive. On January 1st, 2026, China's new export licensing rules go live. On paper, they look bureaucratic. In practice, they are a gate. To export silver from China, companies must now demonstrate $30 million in credit, 80 tons of physical handling capacity, full state approval that instantly removes small exporters, mid-sized traders, Western intermediaries. China is not banning silver exports. It is doing something far more effective. It is locking the gates. And China already consumes over half of global silver production. Solar, EVs, electronics, AI infrastructure. This policy removes roughly 13% of global supply from the international market overnight, at the exact moment when Western tech giants are desperate for more metal. This is not coincidence. This is strategy, and the market response is visible. Shanghai physical silver just printed $90.25 per ounce. 90, not futures, not paper, delivered metal. That's more than $10 above Western spot pricing. That gap is not an anomaly, it is a verdict. Because arbitrage no longer works. You can't buy silver in New York and ship it east. The metal isn't there. COMEX registered inventories are down 70% since 2020. 70%. And the paper to physical ratio, 356 to 1. 356 claims for every real ounce. That is not a market. That is a vulnerability. And the buyers know it. That's why they're bypassing the system. That's why Nvidia isn't hedging. That's why Tesla is securing supply directly. That's why Apple is locking in contracts years out. This is industrial hoarding, and it's rational. The so-called era of thrifting is over. For years, manufacturers tried to reduce silver usage. Thinner coatings, lower loadings, alternative alloys. That worked, until physics pushed back. Silver is the most electrically conductive metal on Earth. It dissipates heat better than copper. It handles power density that alternatives cannot. AI does not tolerate inefficiency. Solid-state batteries do not tolerate resistance. Advanced power systems do not tolerate compromise. So the thrifting stopped, and the bidding began. This is why the market feels panicked. Because it is, and the financial system is not prepared. Look at the CME. Margins have been raised to $25,000 per silver contract. That's not risk management. That's desperation. They're trying to slow down paper buying before Silver Thursday, before delivery demands spike, before shorts are forced to cover into a vacuum. But margin hikes don't create silver. They only reveal its absence. And now layer in geopolitics. Because this is no longer just a commodity story. The US Navy is blockading Venezuelan oil tankers. Airstrikes are being reported in Nigeria. A Russian general has been assassinated. This is not noise. This is systemic stress. When global conflict escalates, capital runs to what cannot be printed. Not bonds, not equities, not software, metal. Silver is no longer just an industrial input. It is becoming a geopolitical asset. This is why mainstream narratives are failing. They're still talking about technical indicators. RSI, overbought conditions, mean reversion. The RSI is at 93. Yes, that matters in speculative markets. It does not matter in shortages, because shortages do not resolve through oscillators. They resolve through rationing. This is why surveys now show 57% of retail investors expect silver above $100 in 2026. This is why banks like Goldman are quietly publishing $85 to $100 targets. And this is why the conversation has shifted, not if, but how high. We are watching the end of the software era and the violent return of the physical era. For 30 years, finance told us everything could be abstracted, digitized, financialized, hedged away. Silver is reminding the system that reality still exists. And this is only the beginning, because January 1st hasn't arrived yet, because China hasn't fully closed the gates, because industrial buyers haven't finished panicking, because inventories haven't stabilized, because leverage hasn't unwound. This move is not over, it's just accelerating. And the most dangerous moment in markets is when confidence breaks faster than supply can respond. What happens next is where most people get blindsided, because this is the phase where markets stop behaving like charts and start behaving like systems under stress. Now let's talk about the paper market, because this is where the real fracture is forming. For decades, banks controlled silver through leverage. They sold futures, they rolled positions, they managed price through paper supply. As long as delivery demand stayed low, the system worked. But now delivery demand is exploding, and leverage is no longer protection. It's a liability. Every paper short represents a promise to deliver silver at a future date. But promises only work when inventory exists, and inventory is vanishing. COMEX registered stocks are at critically low levels. Eligible silver isn't the same thing. Eligible just means owned by someone who hasn't said no yet. Registered means available for delivery. That number is collapsing. And when delivery requests spike, someone has to make good. This is why margin hikes are happening. This is why volatility is extreme. This is why banks are nervous, because they are trapped. If they hold their shorts and price rises, margin calls explode. If they cover their shorts, price explodes. If they demand cash settlement, confidence explodes. There is no clean exit. This is how paper markets fail. Not with an announcement, but with a loss of credibility. At some point, someone stands for delivery. And the metal isn't there. That's when the rules change. Cash settlement, force majeure, emergency measures. And once that happens, the paper price becomes irrelevant because the real market moves elsewhere, to Shanghai, to direct contracts, to sovereign stockpiles, to industrial supply chains. That shift is already underway. Look at the Shanghai premium again, $90 per ounce. That is not speculation, that is cost of acquisition. Western spot prices are no longer discovery. They are lag, and this creates a vacuum, a financial vacuum. Metal flows east, vaults drain west, premiums widen, confidence erodes. This is how power transfers in commodity markets. Now, let's talk psychology, because fundamentals alone don't drive parabolic moves. People do. We've passed the smart money phase. Institutions are already in. Industrial users are already panicking. Now comes the crowd. Retail is waking up, not because of charts, but because of headlines. Silver hits new highs, shortages reported, dealers out of stock. This is where moves accelerate, and also where risk skyrockets. Parabolic markets do not end gently, they end violently. There will be days when silver rises $10. There will be days when it falls 15. There will be engineered sell-offs. There will be smash attempts. This is where weak hands get destroyed. But volatility is not weakness, it's pressure. And pressure means something is breaking underneath. The law of the parabola is unforgiving. Most of the gains happen in the final 20% of time, and most participants miss them, or get shaken out before they arrive. This is why timing matters, not entry perfection. Because once availability collapses, price becomes secondary. You cannot buy what does not exist. And this is where Elon Musk's warning matters. Because Musk doesn't speak lightly. He doesn't comment unless the issue is existential. When he talks about silver constraints, he's not talking about price. He's talking about production risk. That's the tell. When the most advanced industrialists on Earth start talking about a metal, it's already too late for the financial system to manage it quietly. This is no longer a speculative trade. It's a supply chain crisis, and supply chain crises do not resolve through futures markets. They resolve through rationing, through priority allocation, through government intervention, which brings us to geopolitics again. Silver is now classified as a critical mineral. That matters, because critical minerals invite state action, stockpiling, export controls, nationalization pressure. China is acting first. The West will respond, not gracefully. This is how commodity wars begin, quietly, then suddenly. Now, let's be honest about risks, because this is not a one-way bet. Parabolic moves destroy people who over-leverage. They punish impatience, they exploit emotion. There will be brutal corrections. There will be fake breakdowns. There will be moments when conviction is tested. This is not a market for day trading. It is not a market for leverage. It is not a market for paper promises. It is a market for exposure. Physical silver removes counterparty risk, but it removes liquidity too. Miners offer leverage, but they come with volatility. Paper instruments offer convenience, but rely entirely on trust. There is no perfect vehicle, only trade-offs. The mistake most people make is waiting for certainty. Certainty arrives after price. By the time everyone agrees silver is scarce, it will be unobtainable. This is how asymmetric opportunities work. They feel uncomfortable early. They feel obvious late, and we are transitioning from early to obvious. The era of Western price dominance is ending. The era of Eastern physical demand is beginning. This is not ideology, it's flow. Metal moves to where it is needed most, and right now it is needed for AI, energy, and sovereignty. That is why the price is behaving irrationally, because reality has become irrational relative to old models, and when old models fail, new prices emerge. Whether silver pauses here or spikes next, the direction of control has already changed. Price discovery is migrating from paper to physical, from west to east, from leverage to necessity, and once that shift completes, there's no going back. This is not about silver alone, it's about the end of abstraction, the end of pretending everything can be hedged, the end of infinite leverage. Physical reality is reasserting itself, and physical reality does not negotiate, it dictates. So here's the bottom line. Silver at $80 is not expensive. It is mispriced relative to scarcity. Silver at $100 is not extreme. It is rational in a deficit. Silver beyond that? That depends on how fast confidence collapses. But one thing is clear. The future price of silver will not be set in New York. It will be set where metal changes hands, where factories demand delivery, where sovereigns secure supply. And that place is Shanghai. History will look back on this moment, not as a rally, but as a transition. A moment when paper lost authority and physics took it back. If this analysis helped you understand what's really happening beneath the headlines, if it helped you see past the noise, like the video, share it, subscribe, because this story is unfolding in real time. And when the market finally admits the truth, it will not wait, it will not ask, and it will not be gentle.